Hello, everyone, and welcome back to these live virtual classes from the Board of Studies on the topic transfer pricing. Today, this is going to be the last lecture for transfer pricing. We finished, I think it was a long journey. We started with how transfer pricing comes into play, and today we will be talking about very specific issues that actually erupt in a transfer pricing analysis. So, yes, without any delay, let's get started with the agenda for today, which is going to be something called as secondary adjustments. And then we will discuss something called as limitation of interest deduction rules. This is going to be section 94B of the Income Tax Act. After that, we have a small portion on penalty, which is very specific to transfer pricing issues. And after that, I have a few practice questions. I was going through the manual, and what I actually realized is that most of the questions that are actually provided in the manual is what we've already covered while we were discussing specific issues. And also we will be covering them, towards the end of the lecture today. So what we'll do is after we finish with secondary adjustments, limitation of interest reduction rules, penalty, we'll discuss a few questions, a few practical, examples to discuss everything that we've completed till now. After that, I would be happy to take any questions that you guys have on the entire course that we've covered. If when we finish with your questions and your doubts, after that I'd like to take you guys through the manual to just tell you how things are to be completed when it comes to transfer pricing. So that's really the agenda for today that I have in mind. If you have anything that you want me to cover separately when it comes to transfer pricing, I'd be more than happy to help you. So anything specific that you guys have in mind that you'd like me to incorporate in today's lecture? Okay, I hope I was audible all this while. I hope the slides are also visible. Okay, great. So this is what we were discussing in the last lecture. We started with something called as specified domestic transactions. Um, um, we started with something called as specified domestic transactions, and we started with the first concept, which was why do we have transfer pricing on specified domestic transactions. So we were talking about how there is a tax arbitrage that can happen in certain domestic transactions also, because there are two units, there are entities that could be prevalent in two units, one in a DTA and the other in a non DTA. So this is the reason there could be a problem, and this is the reason they came up with something called as specified domestic transactions in section 92BA. This is how SDTs really look like. These are really the transactions on which specified domestic transaction is attracted, and these rules are something that hold true for the methods that we've discussed for documentation, and for within documentation also for TP study and for accountant's report. The applicability is when the threshold exceeds 20 crore for all these aggregate transactions put together in 1 year. Uh, this is what we were discussing. This is the summary for specified domestic transactions. After that, we started with documentation. And as far as documentation is concerned, I was telling you that, as far as Indian documentation is concerned, the local file, there are two folds to it. There is something called as Form 3CEB or Accountant's Report, which is coming from Section 92E. And this is something which is mandatory. It is to be filed with, it is to be filed on the portal. And then there is something called as a transfer pricing study report, which is section 92D, which is a very, very extensive documentation which covers a lot of aspects to what we've mentioned in the accountant's report. After that, there is obviously, a threshold out here, which is, 1 crore. But then we were discussing the nitty-gritties to what the transfer pricing study report, really looks like in terms of maintenance. After that, we discussed the OECD Action Plan 13 report. This is the three-tier documentation structure, and it incorporated something called as the local file, which we just discussed. Then there is master file, and then there is something called as CBCR. Can you tell me the threshold for CBCR in India? Can you tell me the threshold? Okay, yes, 6,400 crore is the threshold for CBCR in India, and beyond this, it is going to be filed in the parent entity's jurisdiction. However, when it comes to local file and master file, they're actually filed with the local tax authorities. So this is all that we were discussing. Advantages, as I mentioned, there has been a past question which basically talked about what are the advantages of this three-tier documentation structure. This is the threshold limit we were talking about. Then we were talking about the alternate reporting entity. There is a time limit, constituent entities, no obligation in certain cases. And then we were talking about finally master file. Can you tell me what the master file threshold in India? What is the threshold for master file in India? Okay, it's a little technical, but it basically talks about two aspects to it. There is part A, which is mandatory in all cases to master file, and then there is part B. Oh, this looks like a copy paste. But yeah, part A is mandatory. No, maybe not. Um, Part B is 500 crores in terms of the consolidated group revenue, and then there is international transactions that you need for 50 crores, or it's intangible transactions which should exceed 10 crores. So that is basically the requirement for master file part B. After this we discussed transfer pricing disputes in India, and which basically talked about how there were simple issues initially, but then things changed, and from simpler topics they came up with more complex issues on recharacterization, marketing intangibles and location savings, and financial transactions, guarantee transactions, etc. This was Section 92 CA, which basically talked about the reference to the transfer pricing officer. And it's not just on, reference that is made by the assessing officer to the TPO, but it also goes a little beyond. Even during the process, if the transfer pricing officer comes across any international transaction, they could actually determine the ELP for that also. So this is what Section 92 basically CA basically says, and the TPO will determine the ALP based on all the information that they have actually gathered from the assessee or from different sources, and then they would make the order of the TPO. It's going to be binding on the assessing officer, and the assessing officer will calculate the income of the taxpayer in conformity with what the TPO has basically said. After this, we started with something called as, safe harbor rules. Safe harbor rules is something which is, specific to international transactions. And this is where I mentioned that, when it actually comes to, when we talk about safe harbor rules, this is where there are a few circumstances that are actually laid by the income tax department in terms of eligible assessee and eligible transactions. If the transaction of the assessee is an eligible transaction, and I mentioned, if you guys remember, I displayed the screen to what were the eligible transactions. So provision of ITES services, KPO services, etc. So all those host of transactions. Then whatever is mentioned in the safe harbor rule is something that will be adopted by the tax authorities. It has to be adopted by the taxpayer, and then it will be accepted by the tax authorities. So that is what safe harbor rules really talk about. Can you type down a few benefits of safe harbor rules, please? Anyone who can type down a few benefits of safe harbor rules? Um, it sounds, I know, very simple, but these are advantages of three-tier documentation structure, etc. These were the questions that were actually asked in exams previously. So we thought, yes, talking about the benefits, reduced compliance, tax certainty, etc., are basically the benefits of safe harbor rules. Thank you for your answer. But I'd like everyone else also, to participate. Please send out answers here, or you can unmute yourself. This is, as it is the last lecture, I think it'll be interesting, to have as much participation, for today. So, yeah, this is what we were talking about, safe harbor rules. And there is certainty that it actually provides, there is compliance relief, and then there is administrative, simplicity. This is the benefit of safe harbor rules. And you can look at this particular slide later on when you're revising. This is the eligibility of safe harbor rules, the eligible transactions and specified domestic transactions. These are the eligible assessees. These are the transactions, and this is the slide that talks about a few examples relating to safe harbor rules. Any questions till now? Okay. After this, we were discussing something called as APAs, Advanced Pricing Agreements. And APA, as I mentioned before, is more like, it's an arrangement between the tax authorities and the taxpayers, wherein they determine in advance of the control transaction, ahead of the control transaction, an appropriate set of criteria. They discuss what will be the method, what will be the comparables, adjustments, critical assumptions, etc., for the determination of transfer pricing for some transactions over a fixed period of time. Can you tell me the maximum period for which APA certainty is offered in India? It talks about a fixed period of time. What is this fixed period of time from an Indian perspective? Okay, yes, that's absolutely correct. It's actually 5 years plus, 4 years. So a fixed period of time as an APA can be taken for a maximum period of 5 years. And then we also have rollback provisions in India, which roll us back to, 4 years. So in India, we have a tax certainty of 9 years as far as APA is actually concerned. This is the slide that talks about, the benefits of APA. So there is tax certainty again, minimum exposure to penalties, reduced litigation, etc. This was the slide that talks about the process for APA. So this is where they talk about persons that are eligible to apply who have undertaken international transaction or who contemplate to undertake an international transaction, which is provided in Rule 10G. They talk about a pre-filing consultation which has to be carried on for the purposes of APA. A question there, in case of only future term APA, total can be 10 years. Future term APA. No, you cannot have 5+5 for sure. It is 5+4 only. So maximum period for which you can get APA is 9 years, and then after 9 years you can apply for APA renewal. So maximum you'll get it is for 5 years, and then after that you'll have to apply for renewal. This is there was a question also for this. It basically talks about when APA, comes into existence, when APA can be, filed. And this is for recurring transactions. It is before the first day of the previous year. And for all other transactions, it's before undertaking that kind of transaction. These are some of the observations with respect to APAs, that it's going to be binding on, the taxpayer and the tax authorities, not binding. If there is any change in law or change in fact, then it's not going to be, binding. And the provisions of APA will override the provision of Section 92C and 92CA. It's always based on negotiation, as we mentioned, and it's also based on a set of assumptions. This is the APA filing fee that we have in India. It was introduced in 2012, and this is what the APA filing fee really looks like. This is the slide on validity. I'm sure you know validity by now. This is the slide that talks about revision of an APA. There have been questions in the past with respect to APAs, whether APA can be revised or not. So they've actually, I think this particular question mentioned about a bit of case study around APA, and then the entire thing was whether this APA can be revised or not, and under what circumstances. Then the case study also mentioned about whether the APA can be cancelled or not. So it basically made use of this particular slide, this particular rule, and Rule 10R, which basically talks about cancellation of APA. This is the example, that we were discussing in the last lecture with respect to, APA. And when you open the manual, you will see that when the manual talks about APA, they also talk about some FAQs. Now the FAQs were actually released when the APA regime was actually introduced, which basically addresses some queries with respect to the entire process of APA. So I think it'll be useful to just go through the FAQs, but they will make sense only when you're clear with the concept. So only when you're clear with all these particular slides on APA will that particular FAQ make sense. Nevertheless, we will actually go through the entire manual in a while, so we can discuss it then. So yes, this is all that we discussed in the last lecture. And this is what we start with for today, which is basically the concept on secondary adjustment. Before I start with secondary adjustment, any questions now? Anyone who has questions? Okay. Thank you. Okay, so this is the concept that we start with today, which is something called as secondary adjustment. Before I actually start with secondary adjustment, anyone who's heard of this concept called as primary adjustment in transfer pricing? Primary adjustment in transfer pricing. Okay, would you want to share what does primary adjustment really talk about? What is primary adjustment? Okay, the ALP adjustment. Yes, that's absolutely correct. What is primary adjustment is actually provided here. Let's go back to this particular case study that we actually started with, in the first lecture itself. If you guys remember this particular case study, we were talking about situation 2, which basically talked about related parties. Now, in this particular situation, we realized that they actually transacted at the related parties here, which is the parent company and the overseas subsidiary. They transacted transacted at 80 rupees, and 80 rupees was not the arm's length price. Because they transacted at a price which was not the arm's length price, they were able to bring the profits down to 20 rupees. And I was telling you that this situation is not the most reliable, because there will be a transfer pricing adjustment that could be done by the tax authorities. So we discussed what was the transfer pricing adjustment, what is the amount of transfer pricing adjustment that could be made here. What is the transfer pricing adjustment that could be made by the tax authorities here? Yes, absolutely correct. They will increase, there will be an increase in the profit by 40 rupees. Now, what they have to do, what you have to remember is that they will not increase the tax. It's never the tax that is actually increased. It's always the profit, or, the income that is actually, increased. If you see, other situations also, if you see other situations also, it's always, the profit, or it's always the income that is actually, increased. So INR 12, no, that will not be increased. There will be an increase in INR, 40. And, we're talking about INR, but let's just say any amount, out there. So what they'll do is here, they'll increase the income of the assessee by 40 rupees, and then that they will tax it accordingly. So now the tax will be 18 rupees. But going back, this increase in income, because of a transfer pricing adjustment, because of the application of arm's length price, that particular increase is basically called as primary adjustment. So that is the concept of primary adjustment. This is what the slide also says. It says primary adjustment to a transfer price. Transfer price here is 80. Primary adjustment to a transfer price 80, as in this 80, means the determination of transfer price in accordance with the arm's length principle, resulting in an increase in the total income or reduction in the loss, as the case may be, of the assessee. So in this particular situation, there has been an increase of 40, and that 40 is basically called as primary adjustment. So that's one thing to say, that this is, primary adjustment. So if you actually look at the essence of primary adjustment, what they've actually done is that they have increased the income, of the assessee, and then they have taxed the assessee accordingly. So what they've done is, they've extracted the tax on that particular, on that particular 40. So what they've done is they've increased the income. Now the new income is basically 60, and now they have taken out the tax on 60 rupees, which is 18 rupees here. So now we're paying a tax on 18 rupees, and that is something that we need to shell out of our pockets, 18 rupees. But the thing is, where is secondary adjustment coming into place? Well, secondary adjustment basically means that yes, you have increased the income by 40 rupees. That's what the tax authorities have done. But now you should actually bring or remit 40 rupees from your associated, party. And so there will be no imbalance between your cash account and the actual profit of the assessee. So what secondary adjustment basically says is that you don't have to just increase your income by 40, but in reality also you have to make sure that you remit that particular 40 from your associated enterprise. So it basically reflects that the actual allocation of profit, which is between the assessee and its AE, it is consistent with the transfer price, which is determined by the tax authorities. What I'm really trying to say is that there is one thing to say that you have increased your 40 in your books of accounts, but This is what the tax authorities have actually done. But you should actually bring back that 40 and get that particular amount remitted from your associated entity. And that remittance is basically called as secondary adjustment. So let's look at the definition of secondary adjustment. Take a minute and read through this, please. Okay, so reading through, it says secondary adjustment. It basically means an adjustment in the books of accounts of the assessee, okay, and its associated enterprise, and it will reflect the actual allocation of profits between the assessee and the AE are consistent with the transfer price, which is determined as a result of primary adjustment. And so it removes the imbalance between cash account and the actual profit of the assessee. Well, it's not just the tax authorities that are actually concerned with it, but so okay. So what we can do is probably just give me 2 minutes, and let's wait for this, because when we go to this particular slide, I'll explain why it actually makes a difference. Because what India has done in terms of secondary adjustment is something more than this. So just allow me, I think, just 10 minutes, and I'll come back to this particular question. So I think you've gotten the essence of what secondary adjustment really looks like. It just means that there has to be an adjustment in the books of account. As in now, this particular books of accounts, this basically should say that there has been an adjustment. There has been 40 rupees that has been received out here, so that whatever the tax authorities say, whatever is the profit according to them, is also the profit as per the books of accounts. So it will remove that imbalance between cash account and the actual profit which has been received by the assessee. So you have to remit that amount of 40 rupees. Now, it was actually, just the Finance Act of 2017 that introduced this concept of secondary adjustment in India. Otherwise, before 2017, we did not really have the concept of, secondary adjustment in India. So this particular slide basically says that secondary adjustments are designed to ensure that cash profits of the taxpayer are in line with tax profits following a primary adjustment. So whatever are the cash profits of the taxpayer, whatever is provided in the books of accounts, this is in line with tax profits, whatever is determined by the tax authorities. Now, what is, just to answer your question, what happens in India? What if you don't remit? So this is one thing to say that you need to remit this, 40 rupees out here. What if the associated enterprises don't remit this particular 40 rupees? Well, in India, the rules are such that, they say that if you don't remit, then we'll presume that it's more like the Indian entity has given a loan to the associated entity. So what if 40 rupees are not remitted to the Indian entity? Well, Indian tax authorities say that, okay, it's very simple. We'll just presume that this is like a deemed loan that the Indian entity has actually given to the associated entity of 40 rupees. And what will happen? Well, if this is a loan that has been provided, then you will obviously have to provide interest on that particular loan. So there will be notional interest that will be charged in the hands of the Indian entity. I know that there is, this was never a loan, but we'll presume it to be a deemed loan. And if this is a deemed loan, then obviously the Indian entity should receive an interest on this particular amount. So that notional interest will be credited in the hands of the Indian entity, and obviously the Indian entity will have to pay tax on that particular deemed loan. So this is what is the concept of secondary adjustment. If this kind of situation is not provided, then obviously there will be tax avoidance strategies, more strategies on the lines of this particular concept. And this is the reason we've got secondary adjustment provisions in India. Does that answer this question? So let's take a minute and read through these three paragraphs here to explain why secondary adjustment provisions in India. Well, there is a question on the chat box which says the intent of the law. Well, the intent of the law is to make sure that those profits which are provided in the books of accounts, those are also in line with the tax profits. If they are not in line with the tax profits, there will be a tax avoidance strategy that will come into play. So just to avoid tax avoidance strategies, they came up with this particular concept on secondary adjustment. The thing is that secondary adjustment is now provided in the tax law of a lot of countries around the world. For some, it's for some countries, it's more like they treat secondary adjustment cases as equity contribution or equity contributions. Yes, in India they consider it as deemed loan. So that's the concept that we follow in India. So I think this is, you don't have to necessarily take the tax thing into consideration, but even from other aspects, it's important that, even from an accounting perspective, if you see, this figure was not in line with what has been done from a tax angle. So that was also the reason that they came up with secondary adjustment, issues. And because there was no repatriation that was happening from the associated entity, they had to consider it as a deemed loan. And there was tax that was offered on that particular deemed loan. So this is what this particular paragraph says, that whereas a result of primary adjustment to transfer price, there is an increase in the income, this excess money should be, which is available with the associated enterprise, should be repatriated to India. So they're really trying to say that, whenever there is a primary adjustment, there is secondary adjustment that should follow. So only when there is primary adjustment will secondary adjustment come into place. And what happens? Well, whatever is the excess in money out here, the excess money is 40 rupees that should be repatriated to India. If the repatriation is not made within the prescribed time, we'll discuss the prescribed time also in a while. Well, then the excess money will be deemed to be an advance which is made by the taxpayer to the associated enterprise. There will be notional interest that will be charged, and it will be offered to tax by the Indian taxpayer. So these provisions actually just came in to make sure that profit allocation between AEs, they are consistent with transfer pricing adjustment. Howsoever profit is being divided, profit is being allocated between the associated enterprises, that should be in line with primary adjustment. There is a primary adjustment which is being carried on in India, but if you look at it from the other countries' perspective, it should be in line. Whatever profits are being retained or whatever income is being retained by the other enterprise, this should be in sync with the primary adjustment that has happened in India. And this is the reason they came up with secondary adjustment issues, secondary adjustment concept. Any questions on the concept? We'll move ahead otherwise with the applicability. Does it make sense now? Anyone who'd like me to repeat this concept? It's absolutely fine. I think it's a little technical, so happy to repeat it. Yes, that's absolutely correct. First, what you do is um, find the income which is increased by this method. No, not exactly. So, tax, the taxpayer does not increase, the income. What we do is whatever is the transaction amount, we try to justify that particular amount. So if we transacted at 80 rupees, we'll try to justify this 80 rupees. But then if the case goes into scrutiny later on, well, that is where the tax authorities might make an adjustment on this particular amount, and they will make an adjustment of 40 rupees there. That adjustment that is made by the tax authorities, that is called as primary adjustment. And if there is primary adjustment, only then secondary adjustment will follow. So step one is that we file our documentation, transfer pricing documentation. Case goes into scrutiny. There is a transfer pricing adjustment. That transfer pricing adjustment should be accepted by the taxpayer. If it is not accepted, then obviously it goes into litigation. But if the transfer pricing adjustment is accepted by the taxpayer, then there is a primary adjustment. And if there is a primary adjustment, then the need comes for secondary adjustment. Okay. So yeah. So this is the slide that actually talks about secondary adjustment. I just told you that secondary adjustment comes into place whenever there is primary adjustment. So how can primary adjustment happen? Well, primary adjustment to the transfer price can be made suo motu by the assessee in his return of income. Now, this is an interesting point. Now, let's say that the assessee has transacted at 80 rupees. The assessee also knows that 80 rupees is not the arm's length price. However, still the assessee has transacted at 80 rupees. So what taxpayers or assessees generally do sometimes is to offer to tax that particular adjustment. So they will accept in their documentation that 80 rupees is not the arm's length price. They should have transacted at 120 rupees, and they will offer to tax 40 rupees as a primary adjustment. So this is primary adjustment which is made suo motu by the assessee in their return of income. Sometimes primary adjustment is made by the assessing officer and it is accepted by the assessee. So if this is the regular case wherein primary adjustment can be made by the assessing officer and then it is accepted by the assessee, then the next thing is to do secondary adjustment. Then primary adjustment can be determined by the APA, which is entered by the assessee under section 92CC. Now, this is what we just discussed, APA, wherein the tax authorities and the taxpayer, they negotiate and maybe they've come up to a primary adjustment out there, which is accepted by the assessee in the APA. So that can also lead to primary adjustment. Primary adjustment, the fourth point says primary adjustment is made as per the safe harbor rules. So it can happen there also. Or a primary adjustment is arising as a result of resolution by way of an assessment by MAP under DTAA. So as I mentioned, MAP is also a mechanism of dispute resolution. So if primary adjustment is made under mutual agreement procedure, MAP, well, then also there is primary adjustment, and what will follow is something called as secondary adjustment. However, there is a threshold out there. Now, the threshold is that the primary adjustment should be, 1 crore for secondary adjustment to actually come into existence. So secondary adjustment will not be carried out if primary adjustment does not exceed 1 crore rupees. Only when primary adjustment exceeds 1 crore rupees will secondary adjustment come into place. So the 40 rupees that we were talking about, it's obviously not 40 rupees. It's actually 40 crore rupees or even 4 crore rupees. As long as it's more than 1 crore rupees, secondary adjustment will, come into place then. Also, if the primary adjustment is made in respect of assessment year 2016 or an earlier year, well, then also secondary adjustment will not come into place because secondary adjustment provisions were introduced in 2017 in the Finance Act of 2017. So, yeah, that is what is provided here. How is deemed loan taxed? Well, it's not the loan amount, which is actually taxed, because it's basically the interest that you receive on that particular loan that is actually taxed. Implying under non-provisions, I think there is nowhere loans are actually taxed. That's correct. It's actually the interest on loan that will be actually taxed. I'm going to just talk about that also in a while. I will talk about the rate of interest, that we'll presume on this, the notional interest. We'll just talk about, all these things. So, so yes, this is something that you need to remember, that secondary adjustment is going to be carried out if primary adjustment is more than 1 crore rupees, and it should be, after 2016-17 assessment year. So what we've done is we've provided again a table here, to just help you understand what the concept of secondary adjustment looks like in India. So let's say that there is an Indian company. The Indian company has transacted, and the transaction was not at ALP with the non-resident associated entity. Now, what will happen after that? Well, it could result in an increase in the total income, or it could result in an decrease in the loss. Well, if that's the situation, there is obviously primary adjustment. What will be the amount of primary adjustment? The amount of primary adjustment will be ALP minus transaction price, as in the primary adjustment will be ALP, which we're presuming in this case this is the ALP, so it will be 120 minus the transfer price, which is 80, so it's going to be 40. 120 less 80, and this should be more than 1 crore rupees for secondary adjustment provisions to come into place. If primary adjusted amounts, that is the difference, is not remitted to India within 90 days, this slide just talks about 90 days. I'll display those kind of rules also in a while. So this has to be remitted to India. What if it's not remitted to India within 90 days? Well, this will be considered as deemed loan, which is given by the Indian entity to the non-resident AE. What happens if this is a loan? Well, there will be interest on deemed loan that shall be added in the hands of the Indian company. And what will happen if there is income in the hands of the Indian company in the form of notional interest? Well, they'll have to pay tax on it. So that is what the secondary adjustment provisions really talk about. Okay, so this is, everything that we've discussed till now. This is what is provided here. I'd suggest that you take 2 minutes and just read through this particular slide. This is exactly, what I mentioned today. And then we'll go into the time limit and the interest. So, okay, does it make sense? Shall we move on? Any point which is not clear here? This one, I think there are doubts here, which basically says that this is not, I think the second one is not clear. Well, this particular, let's talk about the first paragraph, wherein it basically says that this is going to be the excess money will be deemed to be an advance, like a loan, which is made by the associated, which is made by the Indian entity. Now, the thing is, I've mentioned it here that secondary adjustments can take the form of constructive dividends, equity contributions, or constructive loans. But what we have in India is that this is considered as a deemed, loan. This is the second paragraph, which basically says that such excess money or part thereof may be repatriated from any of the associated enterprise of the assessee which is not resident in India. They're really trying to say that, as our end goal is to basically have that 40 rupees remitted to India. Now, whichever entity it's actually coming in from, we don't really care, as long as it's actually remitted to India. So if in this particular situation, if in this particular situation they have interacted, they have transacted with an overseas subsidiary, as long as this overseas subsidiary is sending in 40 rupees, or it's any other associated entity of the Indian entity, part of the multinational group, which is actually sending in 40 rupees, it does not really matter, as long as the Indian entity's accounts are in sync with the primary adjustment. That's absolutely what we actually need. So wherever any of the associated entities which is not resident in India, which is basically overseas, can actually send in or can actually repatriate those 40 rupees. So this is what this particular statement actually says. This is the slide, that talks about the time limit which is provided within which the repatriation should happen. So this is Rule 10 CB 1, which basically prescribes the time limit for repatriation of this particular money. Generally, it is 90 days from the date which is given in column 3 with respect to column 2. Now, the reason that they have, different situations or different cases in situation 2 is because primary adjustment can happen in a few situations. Primary adjustment can happen suo moto by the assessee in their return of income. So if that's the situation, well, it should be 90 days from the due date of filing the return of income. Well, if the primary adjustment is made by the assessing officer and it's accepted, well, then you will have to look at the date of, the order. And 90 days from the date which is given in the order date, well, that will be the time within which repatriation should happen. If it is, the APA, these are the dates which are provided here: the date of filing return of income or the end of the month in which APA has been entered into. If it is safe harbor rules, well, then it's going to be 90 days from the due date of 139(1). If it is DTAA, or if it is because of mutual agreement procedure, then the date giving effect by the assessing officer under Rule 44H. 44H is the rule which complies with MAP procedure in India. So whatever is the date which is provided here, it should be 90 days from that date. So generally, if you actually see, the time limit is 90 days looking at a particular circumstance. So generally, repatriation should happen within a period of 90 days. Now, what if repatriation doesn't happen within a period of 90 days? Well, this will be considered as deemed loan, and then there will be interest that will be imputed on this particular deemed loan, and that will be considered as the income of the Indian entity. So this is what is provided here. If the international transaction is denominated in Indian rupee, well, it's going to be the SBI rate, and if it is in foreign currency, it's going to be LIBOR. LIBOR, seriously? Well, this is where I've just mentioned the update. It's not as if this particular rule has been changed with respect to LIBOR. So they've not really issued a blanket replacement formula. But then obviously the CBDT has acknowledged their move away from, the LIBOR. But then if you actually look at the rules right now, even today, for the purposes of Income Tax Act of 1961, they still say LIBOR as far as rules are concerned. In practice and in litigation, the things are a little different, but this is what the rules basically say. So this is what is provided in terms of, the interest for the purposes of notional interest. Okay. Now there is one more thing when it comes to secondary adjustment, another twist and turn. But before I actually get on to that particular twist and turn, I want to understand if this is clear. Any questions here? I'm just waiting, I'm giving it some time because it can get a little, tricky. These are a little tricky as concepts. Okay, so I will move on with the next concept. Now, the thing is, what if repatriation is not happening within a period of 90 days? Like, do whatever, but repatriation is not happening. It's not going to be repatriated within a period of 90 days, and 90 days have surpassed, and still repatriation has not happened. Well, in this particular case, the income tax authorities they give another option out here to the assessee. They basically say that on this particular excess amount, which was 40 for our purposes, you pay an additional income tax. What is the additional income tax? The additional income tax is at the rate of 18%, plus there will be surcharge at the rate of 12% and cess at the rate of 4%. So essentially, it becomes 20.9664%. So they basically say that you have to pay additional income tax on this particular excess amount. And if you pay this particular additional income tax, you will not be required to make secondary adjustment. Then you don't require to repatriate the amount. You don't consider it as secondary adjustment. You don't require secondary adjustment. You don't require to consider it as a deemed loan, and you don't have to compute interest on this particular deemed loan. So this is more like a final payment of tax. This additional income tax, this is like a final payment of tax in respect of this particular excess money. But then the thing is that no further credit will be available to the assessee. And in this particular amount, no deduction can be availed, by the assessee also under any of the provisions of the income tax, not just transfer pricing. Under any of the provisions of the income tax, no deduction will be allowed, no credit can be, made. So this is what the tax authorities really say. The law says. Is there any issue with applying LIBOR? We're moving away from LIBOR, and this is the reason I mentioned it out here. Uh, okay, so coming back here, yes, this is the option that has been provided by the transfer pricing law. They basically say that you don't have, if you're not remitting or if the remittance has not, reached, well, there is an option to pay additional tax, and this additional tax is at the rate of 18% plus cess and surcharge. And if this additional tax is actually paid, then there will be no requirement of making secondary adjustment, and then no imputation of interest, no need to pay that particular amount of interest, etc. This will be considered as a final payment of tax, but then no credit, no deduction will be allowed with respect to this particular additional amount of tax. So this is what the law says. Any questions? Okay, so we'll move to an example to discuss how secondary adjustment comes into place. I think this is an excellent example because it tests a lot of things with respect to transfer pricing. It tests, associated enterprises, the choice of method, application of transfer pricing methods, and finally, secondary adjustment, issues. So I'd suggest that you take about 2 minutes and just read through this particular question, and then we'll discuss it. Okay, shall we start the discussion? So this particular question, it talks about PQR Limited, which is an Indian company, and they have advanced a loan of 6 crores to XYZ Incorporation, company resident in Singapore. As on the date of the loan, the book value in the books of accounts of XYZ is 10 crores, and they paid the entire loan along with interest on 31st of August 2024. So the thing is, the first point is, and because you've read the entire question, so the first point basically says that would PQR and XYZ Incorporation be treated as associated enterprises for the purposes of transfer pricing? Yes, so you already know, everyone knows by now that yes, they will be considered as associated enterprises. But I think where a little where my role would actually fit in, I'm sure you know all the rules, by now, would be actually to help you understand how to answer these particular questions. I think it's interesting. What is needed here actually is to provide the law first, to tell the examiner that what the law actually says. So this is where you'll have to first tell them that we know that the two entities are considered as associated entities if loan is provided of more than 51% of the book value of total assets. So this is where you can easily see that the book value of asset is 10 crore, the loan is 6 crore, so it's going to be 60%, which is more than 51%, and hence these are considered as associated enterprises. I think it'll be interesting to tell the examiner that the loan was paid on 31st of August 2024, but then it does not really matter to us because what we're looking at is any time during the previous year. So this is the reason they will be considered as associated enterprises nevertheless. So this is what is provided here. They are considered as associated enterprises. Now, the second thing is calculate the arm's length price of PQR Limited, which sells the same equipment. Oh, sorry, I did not read this. Sorry. Okay, so during the financial year 24-25, PQR Limited entered into an agreement with XYZ Incorporation. They're providing 20,000 medical equipment at a cost of 74 per unit. They want to recompute the income of PQR at arm's length. And this is the second point we actually answer. So calculate the arm's length price of PQR. They sell the same equipment at 9,000 to Y and at the rate of 9,500 to X LLP. Both of them are unrelated parties, and they're not a wholesale dealer. This is where you'll have to choose at this point in time what is the method that you're using for the purposes of arm's length price determination. Can you guess? Not guess. Can you just see what method is being chosen here? Yes, that's absolutely correct. We will be choosing CUP out here. When we choose CUP, we do see that there are comparables that are actually provided. So this is the cost 7,400, which is the controlled price. And this is 9,500 and 9,000 are two comparables out here. So what they've done is they've given us two comparables here. One is 9,000 rupees and the other one is 9,500 rupees. If there are two comparables, how do we compare 7,400 to two comparables? Well, we use something called as arithmetic mean. Why are we using arithmetic mean? Well, that is because if you remember, we were discussing that if the comparables are less than 6, so if the comparables are 2, 3, 4, 5, we use something called as arithmetic mean. We do not use the interquartile range. So in this particular situation, because the comparables are 2, what we'll do is we'll use the arithmetic mean. When you use arithmetic mean, 9,000 plus 9,500 divided by 2, the answer comes to 9,250. So that basically means that we will compare 7,400 to 9,250. So 7,400 is the price at which related parties have transacted. But what is the arm's length price? It is 9,250. So what is the adjustment that will be made? Well, the adjustment will be 1,850. How many products? Well, with respect to 20,000 units. So that basically means that there will be an adjustment of 3.7 crores out there. Now, the primary adjustment in this particular case, or the transfer pricing adjustment in this case, is 3.7 crores. Now, the third point says, what are the options available to PQR Limited in respect of such increase in transfer price by income tax authorities if PQR accepts such transfer price? So now what PQR has actually done is they have accepted 9250 as the arm's length price. And because they have accepted that amount, there was a transfer pricing adjustment of 3.7 crore rupees. What happens if there is a primary adjustment? Well, there will be something called as secondary adjustment. So this is where I've mentioned that on account of primary adjustment of 3.7 crore rupees, because there will be secondary adjustment that will be made. Why? Because the company has accepted the primary adjustment. The primary adjustment is in respect of assessment year 25-26. So more than 16-17 assessment year. The primary adjustment exceeds 1 crore rupees. And so excess money of 3.7 crore rupees will have to be repatriated to India within a period of 90 days from the order of the assessing officer. What if they're not repatriating it? Well, they can pay an additional tax on 3.7 crore rupees. What will be the additional tax? It will be 3.7 crore rupees multiplied by 20.9664%, and that will amount to 77,57,568 rupees. So if they pay this particular additional amount, there will be no credit or there will be no deduction that will be allowed on this particular amount from the provisions of the Income Tax Act. So this is how questions are, to be targeted. I'm sure you know that, it's very easy to know that, yes, there will be secondary adjustment that will be provided. And, this is what you need to write. But when you actually write down an answer, that is where my role comes in. And this is where I want to stress on these particular points right here. You have to tell the examiner that you know what the law really says. So you say that, yes, the company has accepted the transfer price. It is in respect of this particular year, and it exceeds 1 crore rupees. This is the reason secondary adjustment provisions will now come into existence, and they have to be repatriated within 90 days. From which date? Well, the date of the order of the assessing officer. If it is not happening, well, then additional income tax will have to be paid of this. So this is how you target questions. Any question here? Does it make sense? Or shall I explain something again? Any part of this question that you want me to explain again? Okay, great. As far as secondary adjustment is concerned, I have another question that I thought I'll, just talk about. Other methods are very difficult. Sorry, I did not get other method. Oh. Do you mean to say all the other methods for computation of arm's length price are difficult? Okay. I think practice might just help. So we discussed questions on TNMM. We'll, see towards the end of this particular lecture when I take you through the revision. We can just discuss it then. Okay, another question when it comes to secondary adjustment. This was a one-liner which basically talked about this was a very long question, but I've just extracted the part which basically talks about secondary adjustment. And it says, what will be the consequences if suo motu enhancement of transfer price of 14.4 crore rupees is made by Sugandha India on determination of arm's length price of international transactions while filing the return of income. So the reason that I've actually talked about this particular question is to help you understand how answers are made. This is how a perfect answer Well, this is how an answer really looks like, a decent answer with respect to secondary adjustment. Now, first thing that you have to say is that there has been an enhancement of 14.4 crore rupees to the income. This is, suo moto enhancement, and this is called as primary adjustment. And this is the reason there will be secondary adjustment that will have to be made. The second thing that you have to say that it should be repatriated within 90 days from the date of filing of return of income. And this is required since primary adjustment is more than 1 crore rupees. Now, if it is not repatriated, this will be considered to be an advance that has to be made. Then, if it is an advance, there will be interest that will be provided like this. And if this is not repatriated, well, then there will be an option to pay additional income tax at the rate of 18%. It shall not be required to make secondary adjustment or recompute the interest after that. So this is, what I'm really trying to say is that in a very structured manner, you have to answer questions when it comes to secondary adjustment. I think you can take 1 minute and just read through the answer right here. Okay, so that's what secondary adjustment really talks about. The next topic that we have for today is limitation of interest deduction, and this is Section 94B of the Income Tax Act. Let's take a 10-minute break right here, and we'll come back and discuss limitation of interest. If you have any questions, meanwhile, just feel free to post them on the group, on the chat box itself. If I'm audible, if the slides are visible, and then we will continue. Okay, thank you so much. Okay, so now we start with the next concept, which is basically limitation of interest deduction. This is section 94B of the Income Tax Act. Before we actually get started with the concept, a question. How are financing arrangements actually made? How is a company financed? Well, a company could be financed by debt or equity. Now, the thing is, what do you think can be, what do you think is preferred between related parties? Do you think they'd like to prefer debt or equity in terms of their financing arrangements? So when this is between associated entities. Okay, so I think when it comes to associated entities, maybe debt. Why debt? Because if there is higher the level of debt in a company, the kind of amount of interest that it actually pays will also be higher, and that will actually lower its taxable incomes. So what multinationals often do, they actually structure their financing arrangements. They finance their companies in a way to maximize the tax benefits. And how do they maximize this particular tax benefit? Well, they claim excessive amount of interest deduction. What they actually do is they claim excessive deduction of interest in high tax jurisdictions, and this is how they shift the profit to the low tax jurisdiction. And this is also called base erosion and profit shifting. As an example, what they'd actually like to do, multinational companies, if they have an entity, if they have an associated entity or a subsidiary in a high tax jurisdiction, let's say a 30% tax jurisdiction, what they'll do is they'll pay out interest from that particular, jurisdiction. And the if the amount of interest, sorry, sorry, if the amount of interest is, let's say, 10 rupees, they will structure it in a way that the amount of interest that they actually pay is 30 rupees. How would they do that? Well, by increasing the level of debt out there. And what they do is they sort of shift out the profits from that high tax jurisdiction of 30%, and they shift the profits to a low tax jurisdiction, let's say of 17%. So 17% is where they accumulate all, the interest, and they pay lesser amount of tax on that higher amount of interest. So what I'm really trying to do is, what I'm really trying to say is that although debt and equity are, the two instruments through which a company is generally, financed, this particular manner, whether they have debt or equity, actually makes a difference in terms of maximizing or minimizing the tax benefits. And this is the reason they use, debt, because the amount of interest that you pay on debt is tax deductible, and that is what they make use of. However, if you look at equity, the dividend that you pay on equity contribution is not deductible, and this is the reason they make use of, debt out here. Now, this was one of the situation which was actually happening. If you talk about multinational companies, they were increasing their level of, debt, and accordingly increase their level of interest on that particular debt, and that is how they were actually maximizing the tax benefits. This particular concept is also called as interest capitalization, thin capitalization. If you've heard of this particular terminology, thin capitalization. This is what thin capitalization actually refers to. When a particular company is, capitalized, or a particular company is financed through excessive level of debt rather than equity, we call it thin capitalization. And the company is called as thinly capitalized. This is what it actually means. So because it was, a lot of interest deduction was actually happening in these particular situations, especially in case of multinational companies, OECD had to do something. And this is the reason OECD came up with BEPS Action Plan 4. OECD BEPS Action Plan 4. What does BEPS Action Plan 4 say? Well, it talks about limitation of interest deduction rules. And what has India done with respect to these rules? Well, India, because it was in line with the recommendations of OECD BEPS Action Plan 4, India introduced Section 94B. And what has Section 94B done? Well, Section 94B has sort of limited the amount of interest deduction that will be available. So now Section 94B says that are you, transacting with your associated entity? We say yes. Well, is it a transaction which requires expenditure by way of interest? Well, we say yes. This is an interest expense. Well, then Section 94B says that the amount of interest that can be, deductible in the computation of PGBP will actually be restricted. It will be available to a particular extent only, because this is a transaction between associated enterprise, and with associated enterprise you cannot claim deduction on excessive interest. So the point is, what is the amount till which it will be restricted, which will not be deductible? Well, the amount is total interest paid or payable in excess of 30% of EBITDA, or the interest paid or payable, whichever is less. This is something, this particular box is something which might just seem a little tricky right now, but we'll discuss an example right here and it will actually make it easier. But still, just to make it clear to you guys, it basically says what will be the excess interest which will not be deductible. Well, it will be that interest which is paid, or interest paid minus 30% of earnings before interest, tax, depreciation, and amortization. So whichever is lesser, that amount will not be deductible. That amount will be disallowed in PGBP, and that is basically limitation of interest deduction rules. Many questions, I'm sure, but what I've explained till now is that much clear. I'm sure there are many things that you want to ask, but what I've explained is that much clear. Then I'll move to the next concept. Is it clear why they came up with this kind of rule? Okay. So before I actually get started with nitty-gritties to this particular section, this provision will be applicable only when interest expense exceeds 1 crore rupees, and this is from a debt which is issued by a non-resident, which is an associated enterprise. Meaning to say that this particular section will come into existence only when there is loan which is taken by a foreign associated entity, and the interest on that particular amount exceeds 1 crore rupees. Well, then only this particular section will come into existence. So let's see what the interest limitation rules actually look like. The first thing is the borrower an Indian company or a PE of a foreign company? Well, if you say no, then Section 94B will not apply, because it actually applies on Indian companies. When the Indian entity basically borrows, some amount, whenever there is a loan that is actually taken, because now the Indian entity will have to pay an interest out here, and there is a limitation on that particular interest. So is the borrower an Indian company? If you say no, it will not apply. But only if it is yes, then we go ahead. Is the borrower a bank or insurance company or notified NBFCs? Because these are the exceptions that are provided under Section 94B. If you say yes, well, then it will not apply. But then if you say no, well, then only this particular situation will apply. Is the lender a PE in India of a non-resident engaged in the business of banking? Well, this has to be again no, because what we're looking for is the lender being a non-resident foreign company. A non-resident associated entity. It has to be associated and it is a non-resident entity. So then you say no, well then does the interest exceed 1 crore rupees? If you say no, then it will not apply, because this particular section applies only when the interest amount exceeds 1 crore rupees. If you say yes, well, then the excess interest is not allowable as deduction. What is the excess interest? Well, the excess interest is interest which is paid or payable, or interest minus 30% of EBITDA, that whichever is less, that will be the amount that will be disallowed. The thing is that if it is a disallowed interest, it can be carried forward for 8 assessment years for deduction from PGBP, to the extent of maximum allowable interest expense, obviously. So that is what this particular section really says. We'll discuss an example to see how this particular section comes into operation. This is one of the examples that is provided in the manual. I thought the wordings ND limited, etc. These were a little confusing. So I'd just ask you guys to take probably 2 minutes and 1 minute and read through this particular example, and then we'll discuss it. Okay, so this particular question talks about ND Limited. This is an Indian company, and they have borrowed 90 crores on 1st April 2024 from TY Incorporation. This is a London company at an interest of 10% per annum. The said loan is repayable in 5 years. The loan is guaranteed by TY Incorporation, incorporated again in the UK. TD Incorporation, a non-resident, holds shares carrying 40% of voting power in both ND Limited and TY Incorporation. The first point is, do you think these are associated entities or not? There are quite a few that are associated, but what happens to ND Limited and TY Incorporation? These two entities, do you think they are associated or not? Yes, they are associated entities, and this is what is provided in, this is what you need to provide in the answer itself. Net profit of ND is 11 crores. This is after debiting the above interest, depreciation, and income tax of 4 crores. Calculate the amount of interest to be allowed to be claimed under the head PGBP in computation of ND Limited. This is where, if you see, they have, ND has taken a loan from TY Incorporation. Calculate the amount of interest under PGBP in computation of ND Limited, giving appropriate reasons. Also explain allowability of such disallowed interest, if any. Now the thing is, a lot of things out here. A lot of times what happens is, and this is in my experience, a lot of times we'll see that this is actually provided. So, we'll do all the calculations, we'll provide everything, etc. But then it also says, the question also says, explain allowability of such disallowed interest, if any. Now, this is where, we lack. We actually miss out on this particular thing because we're so involved in calculations that we miss out on the second part of the question. So what I'm really trying to say is that read a particular question very, very attentively. There are two parts that it actually talks about, and it's important that we actually give them answer on both these, parts here. So this is what the answer, actually looks like. Um, it's important that you actually give them all the explanation. So I have provided it here that in the present case, since TD incorporation holds 40% voting power in both, more than 26%, it's the same person who holds in both. They ND Limited and TY Incorporation are deemed to be associated enterprises. Now, because there is a loan which is taken and which is between these two enterprises, there will be provisions of Section 94B which will be applicable. Why will they be applicable? And this is, everything that you have to mention. And this is the reason I'm just stressing on it. Why will it be applicable? That is because this is an Indian company that has actually taken, the loan, and Section 94B will actually come into existence. If Section 94B comes into existence, this is what you have to mention, that interest which is paid or payable, or interest paid minus 30% of EBITDA, that will not be allowed as deduction under Section 94B. Another thing that you have to mention is that because the interest amount is more than 1 crore rupees, this is the reason this is coming into existence. I think this is very easily traceable. They have borrowed 90 crores. Interest is at the rate of 10%. So this is the reason 9 crores is basically the interest. Now, how do you find out the amount? Well, we start with net profit, which is 11 crores. I think the earnings basically, it's provided in the exam, in the question. Yeah, out here that the net profit is 11 crores. But what we need is actually earnings before interest, tax, depreciation, and amortization. So interest is 9 crore, 90%, 10% of 90 crore. Depreciation is 5 crore, income tax is 4 crore. All this is mentioned in the question itself. So this is the reason earnings before interest, tax, depreciation, and amortization becomes 29 crores. Now, what will be disallowed? Disallowed amount will be interest paid or payable. What is the interest? It's 9 crore. Interest paid or payable, which is 9 crore, which is, let's say here, this is 9 crore. Or what is the other amount? Well, the other amount is interest minus 30% of EBITDA. So that basically means interest, which is 9 crore, minus 30% of 29 crores, which is 870. So this gives us 30 lakh rupees. So what is the amount that will be disallowed? Well, it will be interest paid or payable 9 crore, or this particular amount 30 lakh. So what will be disallowed? It's going to be 30 lakh, which will be disallowed. So what will be allowed? It will be 9 crore less 30 lakh, which is 8.70 crores. So this is what will be allowed under PGBP. Now, it's a very, very important that you actually tell them about 30 lakh right here. The allowability. Now, don't forget this point. Explain the allowability of such disallowed interest. So this is where you tell them that disallowed interest of 30 lakh can be carried forward to 8 assessment years to the extent of allowable interest under PGBP, etc. So this is how you need to tackle the question. Income tax rate is not given, income tax is given. So this is the reason I'm going to just calculate it here. Earnings, earnings before interest, tax, depreciation, amortization is equal to this 11. It's going to be 11 plus 5 plus 4 of tax plus interest, which will be 10%, 90 ka 10%, which will be 9. So that will give us 29. And then what we need is tax interest paid or payable, which is 9 crore less 30% of 29, which is 8.7. So it's essentially 9 minus 8.7, which is 30 lakh. So this is how 30 lakh is going to be disallowed. Okay. Okay. Anyone who has questions here? Any question with respect to entire limitation of interest deduction rules? Shall I talk about this question again? No, 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 don't do that. Don't waste our time. Okay, okay. Yeah, okay. When I talk about discussing something again, there are instant answers, but yeah. Okay, so the next topic that we have is going to be penalty under transfer pricing. Penalty under transfer pricing, I'm sure you agree with me. This is something which does not. This is something which does not require a lot of explanation. This is something which is just provided here. But these are penalties that I have incorporated in the slides here, which are very specific to transfer pricing. So these are the sections that actually talk about penalties right here. Maximum what I can do is just explain you the nature of default and make it aligned with whatever are the sections that we've discussed till now. So there is section 270A subsection 9, which talks about failure to report international transaction or deemed international transaction. This is if you don't report the transactions, this will constitute as misreporting of income, and there is a very, very high penalty of 200% of the tax payable on this particular underreported income. So what I'm really trying to say is that the failure to report an international transaction is going to have a tax of 200% out here. Then if there is failure to furnish, the accountant's report, if you don't, furnish Form 3CEB, it's like a standard, penalty of 1 lakh rupees that will be, levied. Then if the assessing officer requires for information or document, the penalty is, and there is failure to do that, then the penalty is 2% of the value of international transaction. Then if there is TP study report which is not maintained, or the international transactions are not reported, or the furnishing of information is not there, well then this is going to be 2% of the value of international transaction. And the point is that this penalty of 2% of the value of international transaction, this is in addition to if you don't furnish Form 3CEB. So this 2% is going to be over and above the 1 lakh penalty out there. This is not in substitution. Then this particular, shall I move to the next slide? Or probably you can take a minute and just gaze through this particular table. Okay. The next table talks about the penalty for not furnishing of a report, generally about CBCRs, etc., and the report that is required to be furnished for transfer pricing purposes. This is the penalty is 5,000 per day, or 15,000 per day when it exceeds 1 month. And this is also where it talks about 5,000 per day of continuing failure. And if it is in the service of order, it's going to be 50,000 per day. There are penalties. This particular penalty is provided here as well. 271 GB subsection 4. It actually talks about the same thing. It talks about if there is inaccurate information that actually goes in the CBCR, the country by country reporting, the penalty is 5 lakh rupees. If the entity has knowledge of inaccuracy at the time of furnishing of the report, or they discover the inaccuracy after the report is furnished, and there is failure to actually correct it. If there is reasonable cause of failure that is actually proved, then the penalty can be revoked. And this actually was applicable here also. The no penalty would be no penalty would be levied if the assessee proves that there was a reasonable cause of failure in that particular situation. So these are the penalty provisions that are provided for transfer pricing purposes. What I have next are two practice questions that we will be discussing. These practice questions will just test everything that we've discussed, till now. So they are very, very extensively, involved in terms of these. Um, we'll start with the first one, which is this XE Limited, and these are questions that I have taken up from the practice manual. So once we cover all these questions, these two questions, it covers the practice manual, the manual also for you guys. And I'll talk about other examples in the manual in a while, but let's take about 2 minutes and read through this particular question, and then we'll discuss it. Okay, let's discuss this question and see what it says. It talks about XE Limited. This is an Indian company, and there is Z Incorporation, which is a US company. It has 28% shareholding and voting power. Yes, we already know that these two entities will be associated entities, but this is what we need to write in the answer itself. Because the shareholding is more than 26%, these two will be considered as associated entities for the purposes of Indian transfer pricing law. Now, following transactions were affected between these two associated entities. XE sold 1 lakh pieces of t-shirts at $2 to Z Incorporation, and two identical entities to a third party entity, they sold it at $3 per t-shirt. Then they borrowed 2 lakh dollars from a foreign lender based on guarantee by the associated entity. For this, XE paid 10,000 as guarantee fee to the associated entity, and to unrelated party, they have collected 7,000 as guarantee fee. Then they paid $15,000 to Z Incorporation for various potential customer details to improve business, and they have provided the same thing to us unrelated parties at $10,000. Now they have the exchange rate. XE Limited is located in an SEZ, and the income before these transfer pricing adjustments is 1,200 lakh rupees. We need to compute the adjustment to be made to the total income, and assuming that such adjustments are made by the AO, state whether it can claim deduction under 10AA for this enhanced income. Now, looking at this particular, question, this is the, section that we actually use. So it's going to be section 92A to A, which basically talks about 26% or more voting power. And this is the reason they will be associated entity. The next thing for transfer pricing provisions to be attracted, the next thing is to tell them that, yes, these are international transactions. So whether they're talking about selling of t-shirts, whether they're talking about guarantee fee, whether they're talking about this particular amount of service fee to be paid, these three are considered as international transactions. Now, because this is an AE situation, they are international transactions, transfer pricing provisions would be applicable. What is the method that you will actually use in these particular situations to look for ALP? Can you guess? Can you look at the method, looking at these three situations, the method that you will use? Yes, that's absolutely correct. It's going to be CUP that will actually be used in these three, methods. So what we actually do is we tell them about, the income out here, which is 1,200 lakh. And then we talk about the first adjustment that will actually be made. The difference will be the first transaction was 1 lakh pieces of t-shirts, $2 to related parties, $3 to unrelated party. So the difference will be $1 of adjustment into 1 lakh pieces, and then multiplied by the exchange rate, which is 64 rupees. So that will actually give us 64 lakh of adjustment. The second is the difference in guarantee fee. So if we go here, there is difference in guarantee fee. To related party, they have given a guarantee of, they have paid $10,000 as guarantee fee. To unrelated party, it is $7,000. So the next will be $3,000 of difference, multiply it by 64 rupees. That will give us 1.92 lakh. And then the third one will be the difference in service fee, which is $15,000 here and $10,000 here. So it's going to be $5,000 of difference multiplied by 64, which is the exchange rate, which is 3.20 lakh. So the total, amount by which the income will be adjusted or the income will be enhanced will be 69.12 lakh rupees. So that is basically the amount. This amount is also called as what kind of adjustment? This amount is also called as what kind of adjustment? Yes, that's absolutely correct. It's also called as primary adjustment. Would secondary adjustment provisions be applicable? No. Why not? Yes, that's absolutely correct because it is less than 1 crore rupees. So secondary adjustment provisions would not be applicable. But obviously the question did not ask that. So we'll not go into that kind of, details. It just talks about XC Limited. It cannot claim deduction under Section 10AA because the amount is enhanced by this particular amount. So they cannot claim deduction under Section 10AA on the enhanced transfer pricing adjustment. So what I'm really trying to say is, again, don't forget about the last part. This is absolutely fine, the computation part, but go through the question again. Just see that you've not missed out on a small part, like this. This is just a one-liner answer, but it's important to provide that also. Any questions? Any questions on this? Okay, we go to the next practice question, which again is not very difficult. It talks about reference to TPO. This is a question which is coming from section 92CA of the Income Tax Act. So I'd suggest that you take, I think, 1 minute to just read through this particular question. Okay, so it talks about B Limited, which is an Indian company, and it has two units, a manufacturing unit in Hyderabad and a trading unit in Surat. There are international transactions with AEs, and the assessment for this Indian company is pending before the AO, and the AO has referred the matter to the TPO, and this is for the manufacturing unit of Hyderabad. The TPO, however, called for details for the trading unit also in Surat. Now, the question is the procedure you have to explain to be followed by the assessing officer before making reference to the TPO. And the TPO has enhanced, the scope of their work. They have also called for details of the other trading unit, in Surat. Is this possible or not? This is what you need to examine. So this is what the answer really says, that you have to provide the answer. Yes, he can do that. That's absolutely correct. You have to give reference to section 92CA. Now, section 92CA subsection 1 says that assessing officer, if the assessing officer considers it's expedient, they can refer the computation of arm's length price to the TPO. But you have to write out the procedural aspects here, that they have to take prior approval of PCIT CIT before making the reference. And this is where 92CA2 TPO can also determine the ALP of other international transactions which have not been referred to him, which have come to his notice subsequently. They can determine that also. So in this particular situation, they can determine it for Surat also. And the same is within the powers conferred under 92CA subs 2A. I think this is exactly what is mentioned here, that this is where they say that they can refer it to the TPO. Prior approval is required. So this is what you have to mention. Then this is where they actually say that they can determine the ALP of other international transactions which have come to the notice of the TPO during the assessment. And then this is where you can write that it's going to be binding on the AO, etc. So this is the table, the 4 points that you have to explain, giving reference to the section right here. Any questions here? Okay, no questions. I will switch the screen and just display the manual. So I think just allow me some time. Okay, so this is okay. So this is how the manual really looks like. Is this visible? Is the screen visible to the manual? Okay. So this is the chapter we were trying to discuss all this while. Um, this is the brief introduction where they actually talk about the entire thing. If you guys remember, we started by discussing the first thing. We started by discussing the multinational companies, how they are able to avoid taxes, how they shift their profits from high tax jurisdictions to the low tax jurisdiction out there. So this is exactly the same explanation. I would suggest that you read this explanation in sync with the problem in the case study that we were discussing in the first lecture itself, so it will actually make it easier. This is the meaning of arm's length price that we were discussing. If you guys remember, we were discussing this definition also, where conditions are made or imposed. This was the technical definition that we were actually discussing. This is again the significance of the arm's length principle. This is in a concise manner. I have provided this in the slides itself, so you can actually read it through here also. Uh, I will just go to the bright line test also. Bright line test is something that we use for intangibles. It has been provided in a very small box in the manual. This is the reason I'm talking about the manual, so that if there is something which is left, we can discuss it then and there. So just allow me some time. When we reach the study manual, I'll just go through that also. Okay, so this is something which talks about the practical difficulties in the application of ALP. Now, this is something, which is not expressly provided in the slides as such, but then I think when you read through it, you will be able to appreciate what it actually says, because this is what we've discussed time and again, the practical applicability. It talks about true comparison is difficult in certain cases because of availability of data, the reliability of data. Then there is absence of comparable market price for intangible transactions. There is administrative burden. There is a time lag. This is everything that we've discussed, till now, and I'm sure that it will all make sense when you actually read through this particular thing. Then it talks about the Indian scenario. Under the Indian scenario, there is Chapter 10 of the Income Tax Act, which provides Section 92 to 92F, and these particular rules that talk about the transfer pricing, provisions. For transfer pricing, now you know that there should be an international transaction. It should be between two or more associated enterprises. And these are some of the examples of international transactions. This is where it says that it could involve allocation or apportionment or contribution to any cost, etc. This is all provided in the slides. And the international transaction must be done at arm's length price. If it is not done at arm's length price, then there will be determination of that particular arm's length price in that situation. The above adjustment, it will result in increase of income or decrease in loss, but the adjustment should not have the effect of reducing the income or increasing the loss. Well, then transfer pricing will not be applicable. This is section 92, where it talks about computation of income from transactions with non-residents. They talk about, the arm's length price, and everything that we've discussed just talks about that. The key words in section 92, associated enterprises, international transactions, and the arm's length price. AEs, this is the definition that we were discussing. This is the general condition that there has to be management, control, and capital. So this is where they've defined these two situations. And then they talk about section 92A2, where they're talking about all these conditions. So what the institute has actually done is they've provided an example for all these conditions provided here. So 26% or more, this is the situation. This is exactly the example that we discussed. This is also the exact example, that we discussed. Enterprise advancing loan 51% or more. This is the example that we discussed in the slides. 10% or more borrowings. This is provided here. Board of directors appointment. If you remember this, these are examples, that I have provided in the slides, and these are exact examples that we've discussed as well. So all the examples of AE are actually covered there. Then they also talk about dependence on, intangibles, 100% dependence. When it comes to raw material, there is 90% or more, which is required, and dependence on sale, common control by individuals. If you remember, this was also the slide that was actually provided. And for AOP BOI, there is 10% or more interest. This is a generic definition to the term enterprise, which is provided here, and it talks about enterprise. It's basically an establishment, a person which is engaged in production, storage, supply, distribution, etc. So you can just read through this particular, definition. They also talk about the meaning of PE, but I'm very, very sure that you, discussed PE in a greater detail than what is actually provided here. Definition of international transaction. This is something that we discussed extensively. Deemed international transaction. This is provided here. But as I mentioned before, I would suggest that you read this in sync with the diagram that I had actually provided in the slides. So just read it in sync with that. And this is the example that was covered in the slides itself on deemed international transaction. So this is what we've covered as well. These are just examples of international transaction. This is the definition of intangible property. This is the definition of the word transaction. We've discussed this. And this is, if you see, this is the small part where we were discussing whether what happens in case of resident assessees and if they have foreign branches. Alternatively, if there is a foreign company and they have an Indian branch, what happens in that particular situation also. So this is provided in the first slide deck itself. And this reminds me, I will share the slide decks tonight. I will be sharing it with BOS, or I will be just uploading it on the portal itself. So you can actually relate it to the slides. This is all that we completed in the first slide deck itself. Any questions till now? Any questions? Okay. Next, they talk about, the arm's length price. So this is section 92C, and this is where they talk about these 6 methods out here. So these are the 6 methods that we've, discussed. These are the 6 methods. This is the CUP method. This is exactly the question that we've also discussed in the slides. So I have tried to, incorporate this also. The US company and CMI Limited, you can go through the slides. It's provided, there also. This is exactly, what we discussed. Then this is the resale price method. Earth Private Limited. This is exactly the, example that I have discussed with you in, the slide deck. So it's provided there as well in terms of the resale price method. This particular example is something I discussed this later on LMN Limited. So you can actually, look at the example later on in the slides. This is also that, we've discussed for cost plus method. Then there is profit split method. For profit split method, they have provided all the the explanation here. But for profit split method, I have provided two examples in the slide deck. You can actually read through those two examples to see how it makes sense. TNMM method, there is an Andes incorporation. This is what was provided in the slide deck itself. So we've discussed this particular example extensively. And then finally, there is other method which is provided here. This is the slide that actually talks about the methods in a concise form right here. There is I think there is a question right here. 4 chapters which are pending: BEPS, interpretation of tax treaties, model tax convention, DTAAs, advanced rulings. I think BOS would be the right person to address this question to. I'm not really sure about other classes. I take care of transfer pricing generally, so I can help you with that. But coming back, this is the slide that talks about the determination of the most appropriate method. And this is where, if you see, this is where it talks about the 5 comparability factors that we've discussed. So, the nature and class of the international transaction, the availability of data, the degree of comparability, etc. Those are the 5 comparability factors. This is this part where it talks about the computation of arm's length price. So this is where they talk about the concept of range and arithmetic mean, which we've discussed in a lot of detail. Multiple year data, this is where they talk about. This is exactly what was provided in the slides, whether multiple year data can be used or not. This is everything they try to explain. In terms of the weighted average. Then this is the concept of range. This is where they say that 35th to 65th percentile of the data set will be constructed. How do you do that? Well, that is also provided. If you remember, this was what we discussed. The range concept, meaning the 35th percentile, the 65th percentile, and the median, which is the 50th percentile. Everything is provided here. I think they've also provided an example also. No, but the example is provided in the slide. So I'd suggest that you go through the example to see how a 65th and a 35th percentile is actually computed. Then they talk about comparables, internal comparable and external comparables. This is something that we've discussed. The process of identification of comparables. Well, we discussed that there is a database that is actually required. So they have provided some databases here. These 3 were the ones that we also discussed. And then they talk about quantitative and qualitative filters. So this is what we discussed in terms of the quantitative filters. And after the quantitative filters, what you have to apply is the qualitative filter. Qualitative filter was exactly where I mentioned that, we make use of, the annual report, and we, try to understand, we look at the website of the company, etc. We try to understand what the company really does functionally. This is reference to the transfer pricing officer. So this is where I had made that chart. We just discussed this particular thing on reference to the transfer pricing officer. So you can, read through this. This is where they talk about safe harbor rules. Any questions till now? Okay, so this is where they talk about, the safe harbor rules very briefly, but I'm sure you know about, when this is the definition of safe harbor rules, that they actually talk about. But I'm sure, you know about the definition of safe harbor much beyond this now. We've discussed examples also with respect to this. So I would suggest that you go through that. This is APAs. Now, if you read through APAs, looking at how I explained it to you guys, I think this should actually, make sense. So this is talking about the purpose of the APA, the manner of determination, validity of APA, binding nature. This is everything that is actually provided in the slides, itself. Consequences of declaring the APA void ab initio, etc. And these are, the rules, the persons which are eligible to apply, the pre-filing consultation that I mentioned, and then the application has to be made like this. This is the example that we've discussed for APA. What is the filing date, etc. This is the applicable fee, the withdrawal, and the terms of the agreement. This is all that we've mentioned. This is the compliance that I mentioned about. This is the annual compliance report that has to be undertaken. Revision of APA, cancellation of APA is what they talk about. This is the provision relating to rollback of APA, that you can actually roll it back to 4 years also. These are some of the definitions that are provided for the purposes of APA. You can, just go through them. And this is, as I mentioned, the circular. This is the question answer format, the FAQs that was actually released by the CBDT with respect to the APAs. So I'd suggest that you actually just go through these particular questions right here. Otherwise, everything is just covered. These are all the questions. Okay. And finally, they talk about secondary adjustments that we discussed today. Now, when it comes to secondary adjustment, they talk about primary adjustment and they talk about secondary adjustment here. The forms, as I mentioned, it takes a lot of forms: constructive dividends, constructive equity, a contribution, constructive loan. But what we have in India is, deemed loan. Then cases where secondary adjustment has to be made, where primary adjustment is actually made. This is cases where secondary adjustment is not required, where it does not exceed 1 crore or it is 16, 17 or earlier assessment year. This is where they talk about the time limit, which is 90 days. This is exactly the table that we've discussed today. This is the rate of interest, the table that we discussed for, the rate of interest. And this is where they talk about the option to pay additional income tax at the rate of 20.9664%. I think this was the question that we discussed today with respect to with respect to secondary adjustment. So this is something that we've also discussed. And from here, they talk about documentation with respect to transfer pricing. I think just allow me, 5 minutes here. I think I need a break for 5 minutes and I'll come back and discuss documentation right here. There are a few other things that I want to talk about very, very briefly. So just allow me 5 minutes here. transfer pricing documentation here, and this is what the manual also talks about, section 92D, where they talk about the transfer pricing study report. But before that, they acknowledge that there is a three-tier documentation that is prescribed under section 92D, which is going to be local file, master file under 92D, and then there is country by country reporting under section 286. Before that, can you guys hear me? Just a very small confirmation. Can you guys hear me? Okay, thank you. This is where they talk about a person who is entering into international transaction, and this is for the master file that they have actually provided it here. This is where they talk about records to be maintained. So this is provided in the rules out here. I think this is what I have discussed also: the ownership structure, profile of the multinational group, description of the business, the nature of international transaction. So if you remember, on the slide, there were three boxes that were provided, which basically talks about the kind of information that actually goes into the TP study report. This is what they also talk about. This is where they talk about, the threshold, 1 crore rupees for TP study report. This is just information to be supported by authentic documents. So this is, like an annexure that you can provide to substantiate the TP study report. This is where it says that it has to be maintained for a period of, 8 years. This is the audit report. When they say audit report, they mean to say the accountant's, report, or, the audit report or Form 3 CEB. This is coming in from section 92E. There are these three parts. The part one is the generic part. Part B, which they talk about, where you have international transactions and deemed international transaction. And then there is part C, where you have specified domestic transactions. Okay, so this is a small portion where they talk about something called as the bright line test. I think I made a very small mention of Maruti Suzuki case, Sony Ericsson, and LG Electronics, case for the bright line test. But this is where they actually talk about this particular concept comes into place whenever there is a transaction relating to intangibles. Now, the controversy was that let's say that there is an Indian entity, and the Indian entity is using the foreign entities intangible. So let's take this example of Maruti Suzuki. Maruti in India had a collaboration with Suzuki in India, and this is where they started manufacturing and selling automobiles in India. So the transfer pricing officer basically said that, when Maruti Suzuki is manufacturing in India, they basically said that, Maruti Suzuki is using Suzuki company's intangible, their brand name, out here. That is what they are actually using. And they're spending on that. This spending is called as advertisement, marketing, and promotion expenses. AMP expenses is what they're really talking about. So they basically say that the kind of AMP expenses that the Indian entity is expending, it's actually more than what other enterprises are, expending. So let's say that the Indian entity, Maruti Suzuki, is spending, 1.6 crores on advertisement, marketing, and sale promotion expenses. Now, when the tax authorities looked at other, independent comparables, those were actually spending just 1 crore rupees, whereas Maruti Suzuki in India is spending 1.6 crore rupees. So the tax officers basically said that you are spending more in India because you are using Suzuki's brand name, because you are building their intangible in India, and this is the reason you should be compensated by the Suzuki enterprise, the associated enterprise out there. That basically concept is a very known controversy in India. It went to the Supreme Court as well. So that is basically the AMP controversy. Now, within this, there is something called as the bright line test. Bright line is basically, the amount of expenditure of other enterprises. When the when the tax authorities say that Indian enterprise has spent 1.67, how are they saying that it's actually more than what independent enterprises are spending? How can you say that? Well, they look at something called as the bright line. They basically say that this is the amount of bright line, this is acceptable, but then if you spend more than this, which is not acceptable, then you are building the intangibles in India for the associated enterprise, and that's not allowed. So that amount is called as the bright line. There was a time that bright line actually came in as a concept from US, case laws, and US, there was a case law, DHL, from where the concept of bright line came into existence. But then in India, we had the Sony Ericsson case, wherein the Delhi High Court basically said that bright line as a concept is not provided in Indian tax laws. There is no statutory mandate for it. And so they basically said that this kind of concept should not be appreciated. So they basically the Delhi High Court in Sony Ericsson basically said that this bright line test should not be allowed. Tax authorities should not be, they are not justified in using something called as the bright line test for the purposes of this particular concept. So bright line basically is not used in India anymore after the Delhi High Court, or the Delhi High Court said in case of Sony Ericsson. This is just a part where they talk about penalties. This is what we've discussed. This is the requirement as per OECD BEPS Action Plan 13. They talk about the advantages of the three-tier structure, country by country reporting, master file, etc. The furnishing of CBCR, etc. This is the penalty with respect to CBCR that we discussed. And this is where they talk about the master file. The persons who are required to keep master file, this is where they talk about the threshold of 500 crores, 50 crores, 10 crores. And the information that goes into the master file. I said that's going to be a high level, overview that goes into the master file. These are some of the, meaning of, some of the terms: constituent entity, consolidated financial statements, etc. And this is where they talk about transfer pricing for SDTs. So meaning of specified domestic transactions. We discussed all these transactions, if you remember, in a detailed manner. So this is the penalty with respect to specified domestic transactions. This is where they talk about, the threshold of 20 crores. This is where they talk about, with respect to specified domestic transactions. This is where they talk about what is, the meaning of AE. This is what we discussed. Determination of ALP for specified domestic transaction. Well, it's the same as for international transactions. Most appropriate, method is the same. Information and requirements under 92D and 92E, as in, it's also the same for specified domestic transactions. So everything is the same for specified domestic transactions, just that they have, the manual has provided this separately. Even for safe harbor, they have provided it separately, right here for specified domestic transactions. This is a small section which talks about transfer of income, to non-residents. You can just read through this whenever there is transfer of assets, to non-residents. This is a small portion where they talk about specific anti-avoidance measures in respect of transactions with persons which are located in non-jurisdictional, areas. This is where they basically talk about how the central government is empowered that they can notify any country as a notified jurisdictional area because of the lack of information exchange out there. This is section 94B, which talks about limitation of interest rules. It talks about the relevant BEPS Action Plan 4, from where it's actually coming in from. And this is excessive interest. This also comes into existence where there is interest more than 1 crore rupees, etc. Carry forward of interest is provided here. And this is the diagram exactly that we, discussed. This is the example that we've discussed where there was, um, interest of 9 crore rupees, etc. We just discussed that example. And after that, these are the examples that they have provided, more examples that they have provided on the entire concept. I went through all these questions and I realized that most of the questions are something that we've covered, in one of the lectures that we've discussed on transfer pricing. So you can also go through these particular, questions again. But we've, I think, discussed more or less all the questions in, the lectures that we discussed. So yeah, I think with this we go back to the presentation. Okay. And I think with this, we also finish with, our lectures on transfer pricing. If you have any questions, even right now, I'm happy to answer them. Otherwise, I think this is what I'd like to actually say, to finish the sessions. All the very best for the exams. Most likely, we will have a revisionary lecture as well. But in the meanwhile, I am just happy to connect with you guys through this QR code. And thank you so much for the wonderful time. I think now, if I go back to, how we actually started with the first lecture, we were just discussing these small concepts on, what is transfer pricing, what is controlled transaction, what is uncontrolled transaction. And I think from there we've come a long way to now discussing what are the secondary adjustment issues and limitation of interest deduction kind of issues. So I think we've come a long way in terms of just understanding these concepts. But for all this, I think I'd like to thank you guys for just being a very, very wonderful audience, and for the interactive sessions, that we've had. I've had a good time, and I hope I was able to justify this particular topic for you guys as well. So thank you so much. So we can stop the recording. Yes. uh, a link with you guys. So yeah, we can have a look at that. But thank you so much. If you have any feedback, I'd more than appreciate it. Okay. Otherwise, thank you so much for the wonderful sessions, and I will see you guys. Thank you. Thank you so much. Sir, I think we can close the session now. Thank you.